Today we will be discussing treasury stock. If a corporation decides to repurchase previously issued shares of stock, those shares are classified as treasury stock. There are many reasons why a company might purchase treasury stock, including to avoid a hostile takeover by another company, to reissue shares to employees as a form of compensation, and to signal to employees or investors that the corporation has confidence in the company. Shares of treasury stock do not receive any cash or stock dividends and do not have voting rights. The treasury stock account is classified as a contra equity account, meaning an increase in treasury stock decreases equity. Treasury shares are classified as issued but not outstanding. Remember that outstanding shares are shares that are held by investors, which is not the case with treasury shares. For example, if a company had issued 10,000 shares but had repurchased 1,000 of those shares as treasury stock, then the company would have 9,000 outstanding shares of stock. Let's take a look at some of the journal entries related to treasury stock. In this situation, at the beginning of the year, a corporation began with 20,000 shares issued and outstanding of common stock $5 par value. We are to prepare the journal entries for the following transactions. So first, on January 24th, the corporation purchased 5,000 shares of treasury stock for $8 per share. So this is the case where the company is reacquiring 5,000 of their own shares. So this journal entry is going to be a debit to treasury stock and a credit to cash, since we're paying out cash. And the amount for the journal entry is going to be the 5,000 shares multiplied by the $8 price per share. And if we multiply those two numbers together, we get $40,000. Remember that treasury stock is a contra equity account, so debiting treasury stock here decreases equity, and crediting cash decreases assets. The other thing I want to note is that this $8 that we have for the treasury stock is going to be important, so remember that we purchased the treasury stock for $8 per share. In the remaining three journal entries, we're going to explore how to account for selling treasury shares at cost, above cost, and below cost. The first case is when we are selling treasury shares at cost. Remember that we purchased the treasury shares for $8 per share, and here we are selling 500 of those shares for $8 per share. So of course the company is going to be getting cash, so we will debit cash for 500 shares multiplied by $8 per share. That gives us $4,000. And then we are going to have to credit the treasury stock also for $4,000. Next, on May 11th, we have 1,000 shares which were sold at $10 per share. So this is the case when we're selling the treasury shares at above cost, at $10 when we had purchased them for $8 originally. Now this journal entry is going to include a debit to cash for the 1,000 shares multiplied by $10 per share, which gives us $10,000. And then we're going to have a credit to treasury stock. Now the important thing to remember here is that the treasury stock has an $8 cost which is attached to it. So we need to take it off at $8 per share. So $8 multiplied by 1,000 shares gives us $8,000. Now remember, treasury stock is a contra equity account. So crediting treasury stock decreases the balance in the account, but simultaneously increases equity. Now for the $2,000 that we're still missing here, we're going to use an account called paid in capital treasury stock. And this is an equity account that we use whenever we sell treasury stock at above cost. Finally, on July 16, we sold 3,000 treasury shares at $7 per share. So this is the case when the treasury shares are sold below cost. This entry is going to include a debit to cash for the 3,000 shares multiplied by $7 per share, which is $21,000. I'm going to leave a couple spaces here, and I'm going to put treasury stock down here. Remember, the $8 cost is associated with the treasury stock, so $8 multiplied by 3,000 shares gives us $24,000. Now, we have a $3,000 difference here between the $21,000 debit and the $24,000 credit. And the way you're going to make up that difference is going to change depending on each problem. Now in this case, and anytime that you have previously sold treasury stock at above cost, you should have this paid in capital treasury stock account. And this is your first place to look for closing that difference. So your first step is to close out this account. So we're going to put paid in capital treasury stock for $2,000. And that's just going to close out this account. Now sometimes that's all you will need to do for this journal entry. If the difference between the debit and the credit was only $2,000 or anything less than $2,000, then the paid in capital treasury stock would be enough to take the difference. But in this case, we're still missing $1,000, so we need a different account. So the account we use if we have closed out the paid in capital treasury stock account, or if we didn't even have this account to start with, is the retained earnings. In this case, we're still missing $1,000 to balance the journal entry, so that's what we're going to put here. Alright, we are finished with the journal entries. Make sure you understand the journal entry when treasury shares are sold at below cost, because that does trip up a lot of students. Make sure you understand when to use the paid in capital account, when to use the retained earnings account, and when to use both of those accounts.